Hey guys, this is Andrew for TRENDLINES.com. So I've been working as a professional trader on the option market for the past 6 years in Hong Kong, and I've just created my YouTube channel where I share with you all the knowledge I have about how to make money on the markets. So in today's video, I want to show you guys how to use options to build some strategies that can help you to actually make big profits without sometimes taking a lot of risk. So let's get into it. Alright guys, so once again, I'm gonna show you something that you guys gonna love. I'm sure of that. So this is actually, I don't want to go too deep into that. I know this is very, complicated stuff. Okay, so I showed you guys already, I'm using like the option data to compute the synthetic short interest. But in today's video, I want to show you something much more interesting. I want to, once again, slowly show you the more technical things we can do in finance as traders, especially on the option market. And I want to show you some very basic option strategies that you can use to make money on those markets. So, for example, let's start very basically. For example, you have no shares, so okay, your share position is 0, you don't have any option for now, so you don't make any money, and you want to buy, for example, 300 call strike. So if you buy one, the quantity, it means you buy like 100 options. So to find the price of your options, so we're gonna stay today on the July maturity. You go on Yahoo Finance, you click on options, you select your maturities. So let's stay on the July maturity because it's kind of easier to start. And you want to buy a 300 call strike. So let's see, the price you need to take into account is the, so here I have bid and ask. Last price is only the last traded price, but it doesn't mean it's what it's worth on the close, all right? Because maybe it has not traded around the close. So don't pay attention to last price, just do the average between bid and ask. So here the average between bid and ask is 19.4 exactly. So your price is 19.4 and the volatility, it's interesting for you just to, put it. I'm going to explain after what's the effect of it, but just, okay, put it. And then I compute my premium. So the premium is only equal to the number of options. So here 100, because one option on the listed market is multiplier of 100. So it's equivalent to 100 an options contract. And the price is 19.4. So this would be a premium of $1,900 US. And how would this look? So I'm having here my 300 call. And so basically it's a payoff that is giving you all the upside performance above the strike level. So basically if we finish at 300, your call option at maturity, your call option is worth nothing. So if you finish at 325, you have gained $25 per option and you have 100 of them. So it's $5,000. So you basically are break even around the strike because your total P&L is the performance of your call option minus the price of your call options. So your payoff is something like this, all right? So this is if you buy a call option, 300 strike. So, but you have no downside risk. So this is the good thing about it. For example, imagine you don't have this and you have, for example, here it was equivalent to 100. Let's say you have 20 shares. Your P&L is very different. So for now we had 160. So if we finish here in July, you're only going to use $200 US. But if we finish at 0, you can lose a maximum of $3,200 US. But on the upside, you cannot make as much as you could if you have like, so the risk is roughly the same. You can use even twice more, but for that GameStop needs to go to 0. And the upside performance is linear. For a call option, you have some convexity. I mean, you don't have convexity above the strike, but you have convexity at spot. So let's go back to this. And now I want to show you something more interesting that you can do is actually if you don't want to spend that much money, you can just decide to buy a call at 300 because you think that GameStop is going to be above 300, but you think GameStop is not going to make new all-time high, so you think GameStop is going to be lower than 480. So let's call it 475. So you buy one here and you sell one here. So what's the price you're going to sell it? 475 between 8 and 14. So it's around 11.10. So 11.10. What's the volatility? 180. All right, slightly higher, which is good. You want to sell those higher vols. So basically this is okay. And now, interesting, because it's not that expensive anymore. It doesn't cost 1,900. It costs only $800. And the performance between 300 and 475 is exactly the same. All right. We have just capped the maximum gains to $16,000. So let me show you again how we were. If you don't sell it, you are like this. So if we go to 475, we are making the same $16,000. And of course, we can make more if we go above, but this costs $2,000. And if we sell the upside call together, we make the same money here, guys. All right. You just don't have the upside performance above your second strike. So this is another option strategy that you can make, which is called a call spread. And I think that call spreads are actually very good to sell when the upside volatility is that high, guys. All right. Look at this volatility, this column. And it's that high because everybody is actually buying. Look, guys, the open interest on the 800 strike is 22,000. So we are talking here about 2 million equivalent shares. And you can see that, which is amazing. And that's why, this is pushing, there are a lot of buyers here. So when they buy the call option, they actually buy its volatility. I'm going to explain, guys, this in other videos. For now, I want to keep it simple. Just keep in mind that they are pushing these prices higher. So you guys want to be on the right side. The right side is not to buy those strikes, all right? It's to sell it. I'm telling you guys. So this is my job. And, I think it's good. I'm telling you that you need to sell those very high strikes. So you can sell them, as I said, by buying a one that is lower. And if you want, you can even sell two, And this would make it look like this. And then it costs you 0. This is a call ratio. So once again, I go step by step, guys, but this is a 1/2 July 300, 475 GameStop call ratio. This is how we would call it at work. And this costs 0. And your payoff has, a shape that basically you're making the maximum money at 475, you're making now $18,000, but you start to lose money if we go above 650 in July, which is possible. So you need to be careful. And let me show you something. You can also add some shares. You can add, for example, if you have 20 shares, you have your 20 shares, and then your payoff is like this. So basically you can do whatever you want with options. So that's it for me. I want to keep it simple in this video. I'm going to do more videos where I show you more option strategies that you can use, especially if you are long. And you're going to see, guys, that this is very, very helpful to actually lock some profits. And it's even very good to use. Instead of buying the dip, you can sell some put options. This is my next video. So if you enjoyed this one, please don't forget to click on the sub, like, and bell button, so you're going to be the first to know when I upload anything new. And stay close to shore. See you guys.